Let's continue with the financial function. What are the tasks of a financial manager? The picture is the CFO of famous brands. And the CFO of famous brands will have to draw up cash budgets for the short term, as well as a capital budget to plan for the long-term financial needs of the business. The CFO need to interpret the financial statements, for example, the income statement and the balance sheet, and will need to make sure that the different departments stay within their budgets. What are the objectives of the financial function? There are 4 very important objectives. The first is to maximize profit, then to increase profitability, to make sure the business has enough cash to cover expenses, and to maintain a good ratio between owned and borrowed capital. Let's look at these individually. To maximize profit by keeping expenses low means you need to cut out unnecessary waste. You need to be sure that you're not overpaying for your marketing, you are not wasting money on unnecessary things, and you need to cut back as much as possible. This is a way to increase your profit. The next is to increase your profitability. We can see our profitability by looking at the profitability ratio, where we take our net profit and we divide it with our capital and we turn it into a percentage by multiplying it with 100. That will show us our profitability. The higher, the better. Next, we will look at having enough cash to cover our expenses, our liquidity. These are done by looking at the current ratio and the asset test ratio. The current ratio will look at our current assets divided with our current liabilities and written as a ratio. The ideal would be to have 2 to 1. This means for every 2 rand we get in from our current assets, we have 1 rand to pay our current liabilities. The asset test ratio is where we look at our current assets, but we subtract stock from it, because stock can sometimes be kept up, and we divide it with our current liabilities. Here it should be 1 to 1, meaning we have 1 rand current asset coming in for every 1 rand liability we need to pay out. And then we also need to maintain a good ratio between our own and borrowed capital. We call this gearing. Gearing measures the percentage of funds that have been borrowed from outside the business for long periods of time. A gearing above 50% is very high, as a large amount of money has been borrowed from outside the business and will have to be repaid. So we do not want a high percentage here. So you take your long-term liability and you divide it with your capital employed. That will give you your gearing ratio. Let's test our knowledge. See if you can answer the following questions. Right, after watching this, I want you to look at the ratio example document that's uploaded. Use the income statement and balance sheet from your study notes. See if you understand how these ratios are calculated. And remember to summarize your work. Next lesson, we are going to have a worksheet on how to calculate ratios. It's important for you to understand this. This is the document you need to work through.